Good day, everybody, and welcome to this month's episode of Cliff Notes on the Global Manufacturing Picture. I'm Cliff Waldman. I'm the host of this show, one of many on Manufacturing Talk Radio. If you missed last month's episode, you may have noticed that things have changed a little bit here. We are now a video program, and that's very exciting. It's a good opportunity for me. It's a good opportunity, I hope, for you. We're able to show things, do different things, have interesting conversations with guests that you'll actually be able to see. I enjoyed podcasting, but I think this is going to expand our capabilities greatly. The next episode, for our November episode, we're going to have a very interesting guest. I'll tell you about him at the end of this program. 2 days after I record this show, I'm off to the Midwest, Chicago, Kansas City, to do a speaking tour. I'm speaking to a number of manufacturing groups who are very intensively interested in what's going on with a very difficult global economic picture. And while we have many, many topics that we want to talk about, that I will be talking about, the global economic outlook is absolutely paramount in our list of things to talk about now. It hasn't been this difficult, certainly since the financial crisis of 2008 and 2009. And we are breaking multi-decade records on a number of very difficult challenges. So before I'm off on my speaking tour, I thought I would share with you some insights that I've developed for my upcoming audiences on the global manufacturing picture. Now, global anything is complicated. And I always tell my audiences, I always will tell my audiences that when you have a complicated subject, when you have a very global subject, the best way is to divide and conquer, to really divide it up into digestible pieces and have a plan for conquering the world, because that's what we have to do when we talk about the economic challenge of the day. So here's what we're going to do. I'm going to set the scene. How did we get into this mess? Where did all this come from? We see the Fed raising interest rates. We see markets quavering. We see great concerns about unemployment, dislocations, all that kind of thing. How did we get into this? And we'll talk a little bit about this. Then I'll talk about a good story, labor markets. For workers, certainly a very good story. For employers, a more difficult story. Then we'll bring in the dragon, the villain of the day, whatever your preference is, inflation. And we'll talk about Fed policy and the dollar, all the things related to inflation on a domestic and a global level. We'll talk about global tremors. This isn't just a U.S. story. And we'll say, well, let's try to predict the ending. How is this story going to end? And what's the world going to look like? I think most importantly, in many ways, for corporate boardrooms, what's the world going to look like when we reach safe ground? And eventually we will. So let's set the scene. In the past couple of years, we've had a list of dislocations and emergencies and crises like, again, we have not seen, certainly since the financial crisis, and maybe in many ways this is a more difficult situation even than the financial crisis was. 21st century seems to be full of crises, but this one at this time seems to be a confluence of a number of difficult things that really have been building over the years. We had a trade war in 2019. That began a problem which continues today, and that is supply chain dislocations. Of course, we have the pandemic, a once a century, a dangerous virus that just stopped the earth for a couple of years. Supply chain disruptions, you know about those. You're feeling them and understanding them probably better than I or any other economist can. Labor market disruptions have been mysterious, have been difficult, good for labor, not so good for employers because you have the problem of getting labor, and that's been very difficult. Then we'll talk about inflation, and we'll talk about the worst war in Europe in 75 years. Quite a time. the worst pandemic in a century, the worst inflation in 40 years, the worst war in Europe, the most dangerous, the most difficult war in Europe in 75 years. All coming at the same time. That's, it shouldn't be a surprise that a global economic crisis is upon us. Let's talk about the job market. We shut the door on the economy in March and April of 2020 when a very dangerous virus began circulating in the United States. We lost more than about 22 million jobs in 2 months. But then, as a result of the tremendous fiscal stimulus and the tremendous monetary stimulus that was thrown at that, the economy came roaring back more than even the most optimistic people could have predicted. And that created a huge gap in the labor market. We have enormous labor demand, but labor supply, not so much. It's been difficult getting people back into the labor market. We've had some increase in the labor force participation rate, which is the percent of workers either working or looking for work, has been actually falling since 2000 with the baby boomers starting to retire. It fell off a cliff during the pandemic, and it's been coming back somewhat, but not that much, and it's still below its pre-pandemic level. So labor supply remains very, very difficult. And that, of course, creates a very tight labor market situation. And that's feeding into a number of things. So for workers, certainly a very good labor market. But then we entered the dragon, inflation. Now, inflation has come to us, and it's the worst spike in inflation in 40 years. Many people around today don't know what this is. They've never experienced anything, because you'd have to go back to the late 70s and early 80s to really know what it's like to live with accelerating prices like we are dealing with now. Well, why did it happen? First of all, tight labor markets have contributed to it. Second of all, monetary policy that has been unusually easy since the end of the financial crisis. This didn't begin with the pandemic. What the pandemic did do was create massive spending. And it's understandable. The world was really shutting down. Massive spending, massive monetary stimulus. Then the Fed was late to the game. They should have seen the inflation coming 6 or 7 months before they did. They were late to recognize the inflation, and they were certainly late to act on it. All that conspired to give us an inflation that is extremely difficult. But it's really important to understand that it's not just a US problem. Many other countries have inflation problems that in some ways are worse than the US. Tremendous inflation problems in the UK, for example. We've seen what the instabilities did politically in the UK. Massive inflation, jaw-dropping inflation through much of Europe, in Canada. It's a tremendous Western surge of price acceleration that is destabilizing the global economy. Now, it's gone. Let's talk about the Fed, and all eyes are on the Fed. They realized that they came too late, and now it's the typical problem. You come late to the game and you try to make up for your tardiness by doing too much too fast. Now, whether it's too much too fast, that remains to be seen. But they certainly have been extremely aggressive in raising their target for the federal funds rate. The federal funds rate is the rate that banks charge each other for overnight loans, by the way. And it's sort of a measure of the liquidity, of the ease with which liquidity flows through the banking system. The Fed doesn't set it. It's constantly talked about being set, but they target it, and they try to target it through their open market operations, which is why the central policy making body of the Federal Reserve is called the Federal Open Market Committee. Now, they are tightening policy tremendously. One thing that's doing that is critical for the world is that it is created a huge spike in the dollar. By many measures, by one critical measure, the dollar is at a 20-year high. It's at a 20-year high against a wide basket of currencies that it trades against. that means in effect that we are exporting our inflation, at least some of our inflation, to the rest of the world, because with the dollar being so high, US goods are much more expensive to Japanese customers, to European customers, to any non-US customers, because it costs more in their currency to buy a dollar, and therefore the goods that are made in the US are more costly to non-US customers. That's difficult. That's creating not just economic havoc, but financial havoc. And again, we saw that in the UK. So it's a time of great instability. Rapid rise in interest rates, rapid rise in the dollar. And we're seeing, so I mean, is the Fed policy working in the United States, or isn't it? Well, certainly in housing, we've seen, probably the most, not surprising, it's probably the most interest rate sensitive sector. And we've seen a sharp fall in, in housing demand. Now, housing supply is still short also. So you would hope that house prices would fall dramatically. That hasn't happened yet. I expect that it will, but this has all been quite slow. And what makes that a little disconcerting and difficult is that the Fed is now absolutely 100% focused on the inflation fight. And with housing prices still not responding in the way that they want to, even though housing demand has pulled back. The fear is that the Fed is just going to keep going, and even if they crash the economy into a wall, they are going to want to keep going until they really start to see inflation come back. And the way they're right. Well, if inflation is unstable, if it's accelerating, then the long-term prospects for the economy are bleak. We cannot have economic stability and therefore economic growth if inflation stability is not there, if inflation keeps going. So they are, at this point, they are correct. But it is making people nervous that they're willing to take a difficult short-term global US and global economic situation in order to cure an inflation that, frankly, let's be honest, they were late to the party to start moving on. So, well, what's going to happen with all this? Where are we going with all this? I would say, first of all, I think there's a better than even chance, and you've heard every forecaster give you their forecast. I'll give you mine. There's certainly a better than even chance that the U.S. is going to hit some kind of recession. It's very unpredictable how deep a recession will be, but the fact that we'll have a pullback, an actual decline in output in the economy, I think is really pretty sure. One good indicator of that, and there aren't many, admittedly, one good indicator of that is the yield curve, and the yield curve has gone negative. The yield curve is a good thing to pay attention to now, because it has been a pretty good, it really, going back decades, it has been a pretty good leading indicator of recession, although it's the timing is that an inverted yield curve can tell you that a recession is coming in 2 months, or it can tell you that it's coming in 2 years. What is it, however? It's important. What is it, and why is it a good indicator of recession? Well, you have to remember that the bond market has a term structure. The longer dated maturities have higher interest rates because investors are going to want to get paid more for locking up their money up for longer periods of time. That, first of all, it separates them from their money for a longer period of time. It's also riskier. More things can go wrong in 10 years than in 2 years. So the normal course is to have an upward sloping interest rate structure where the 5-year pays a higher interest rate than the 2-year, the 10-year pays a higher interest rate than the 5-year, etc. Sometimes they invert, which is an abnormal situation, because what people are telling us is that when they invert, that's because bond investors are telling us, I'm worried about the short-term future. So I'm going to put my money into longer dated maturities because I feel like there's a storm coming now, but it'll be solved sometime. So they'll put more money into the 10-year than into the 5-year That raises the price of 10-year bonds, pushes interest rates down relative to the shorter dated maturities, and you get an inverted yield curve. Tends to work pretty well for forecasting recessions, but the leads are very variable over time. No, none of these indicators are, quite frankly, perfect. What about the world? Well, I think the world is headed for at best a slowdown and very possibly a downturn. All of what's going on with the Russia-Ukraine war, with the energy crisis that Europe is going to be facing, especially as we get into the winter, with oil prices, with inflation, etc. The IMF is predicting that by 2023 we'll have very, very little growth, maybe a 0.5% growth in GDP. It could just as well be a decline of a 0.5%. Europe is going to be pushed to the brink of recession and very possibly into recession. There's no formal definition of a recession outside of the United States, but GDP could just, they're predicting a very, very slight increase in GDP, a major slowdown for 2023. That could be a decline in GDP. China has its own set of problems. COVID lockdowns, demographics, the upheaval in the property sector, which was inevitable. I visited China in 2006, and walking through Shanghai, I saw every available inch of space was going to be built on, even though there wasn't a lot of occupancy. And you walk away with the sense that this can't last forever. Well, it lasted a long time, but now, like everything else, it's coming to fruition. So just, we're going to have a major slowdown in China, and some of it's secular because of demographics. China is a rapidly aging society. It's aging more than most developing countries would at its stage of development. So big slowdown in China, big slowdown in Europe, possibly a contraction in European GDP. I think that's on the cards. The United States certainly headed for a recession of some kind, and the world doesn't look too good. It doesn't look great. We will get through it. We have been through crises before. We will have crises again. This one is very global in scope, and that, by the way, is one way in which the world is changing. We used to, we're going to have less and less time. We're going to be talking about a U.S. recession, unless there's something really strange that goes on. Whenever we get into a circumstance of economic weakness, the links that are afforded to the world by financial markets and by supply chains are going to make every event a global event, I predict. It's going to be less and less sensible to talk about domestic economics and more sensible to talk about the global economic outlook. So really, that makes everything more difficult, more challenging, also interesting. And if everybody thinking about the world is not such a bad thing. I mean, what happened in the United Kingdom shook our markets here because it might as well be the same country. That's the way the world, and at least the same economy. And that's the way the world is working these days. Well, okay, so we get to stable ground. What's the world going to look like? Well, number one, we're going to be in a period where defense spending is going to be back in a Cold War posture, thanks in part to Vladimir Putin, to China's belligerence related to particularly to Taiwan. We are going to be back into a different kind of thinking, a non-peacetime thinking with defense spending, and that's going to matter a lot to our to certain manufacturing industries that we'll see some benefit from that. It's a terrible thing, but it's going to create demand in certain manufacturing industries that have seen only moderate demand, may start to see strong demand. Interest rates are going to be normalized. I used to, the past couple of months, I've been talking about a period of higher interest rates, but really you have to remember that even as the Fed started to quickly move on this inflation, they were starting from essentially zero policy rates that were kept in place probably way too long in the wake of the financial crisis, which ended in something like 2010, 2011. We had much too long a period of, as difficult as the financial and as frightening, frankly, as the financial crisis was, We kept interest rates too low for too long. The birth of this inflation wasn't 2 years ago, it was probably 6 or 7 years ago. So we're going to see more normalized interest rates. We're going to see supply chains changing. We're already starting to see smaller companies, smaller manufacturers talking about finding more domestic sources of supply. This tangle that we've had in supply chains really has upset a lot of companies, upset a lot of people. I'm going to start to think more domestic with supply chain. I don't think, I'm going to hold to my view that I don't think supply chains are going to be totally brought in from the globe. There's too much to be gained out there, but I do think there's going to be some move toward domestic supply chains. So those are a few of the benefits that I'm going to be talking on my Midwestern tour of the global economy for a number of manufacturing groups. I hope that some of you listening to this are going to be there. Look forward to talking to you. Look forward to talking about this. Now let's talk about our guests for the November show. Now that we've gotten up and running with our visual format, it's time to bring a guest in. And Mr. Michael Ryan is going to join me. He's an economics director at what is now S&P Global. I happen to have heard him speak at a conference in St. Louis a few weeks ago, and he's doing a lot of very intensive research on the European energy crisis. That is going to be a bigger an energy crisis that has come from a number of things, but certainly from the Russia-Ukraine war. That's going to be a bigger and bigger part of the risk story in the global economy, particularly as we get into winter. There's a number of interesting and critical insights to offer to it. As to that, he will be our first guest on the new video Cliff Notes program. Looking forward to having him. Looking forward to seeing you there. Thank you very much, and I hope to see some of you in Chicago and Kansas City as I go out to speak. Thank you very much.